Hello, I'm Greg Beckett, co-founder of QTrade Capital, a long-short hedge fund. Today, I'll show you how our proprietary trading system captures upside in bull markets while limiting downside in bear markets, delivering a Sharpe ratio of 1.95, which is 3.6 times better than the QQQ benchmark. This matters right now because 1. The Nasdaq is at record highs, 2. It has a dangerous level of concentration with the Magnificent Seven, representing 62% of the Nasdaq 100, and 3. Bain & Company has identified an $800 billion AI revenue gap that could trigger the correction everyone's worried about. Let's dive in. Mutual fund managers today are facing three converging crises that are making their jobs nearly impossible. First, there's the behavioral problem. Retail investors consistently buy high during market euphoria and panic sell at the bottom. When they redeem during crashes, managers are forced to liquidate holdings at the worst possible prices. Second, the Nasdaq 100 is currently trading at all-time highs and sitting right at the top of its 10-year price channel. Technically, this suggests we're overdue for a significant correction. And third, the AI bubble. We're seeing massive infrastructure spending with revenue expectations that may not materialize. If that $800 billion annual shortfall becomes reality, the concentrated tech holdings that dominate most portfolios could face severe repricing. QTrade Capital offers a solution to all three problems through our adaptive long-short trading system. Let me show you why this matters. This chart tells a critical story. You're looking at QQQ's 10-year price channel. The blue lines represent the long-term trend boundaries. Notice where we are right now, at the very top of that channel at around $600. Historically, when QQ reaches the top of this channel, it tends to mean revert back toward the center or even the bottom. That bottom channel line is around $426, which would represent a 29% correction from current levels. Now, I'm not saying a crash is imminent, but the technical setup combined with record valuations and extreme market concentration creates a risk environment that most mutual funds simply aren't prepared to handle. This is where QTrade's bidirectional trading capability becomes invaluable. Here's where theory meets reality. This is our complete 12-month trading log showing every single trade we made from October 2024 through September 2025. 23 trades, all documented with entry dates, returns, and the VXN volatility index at entry. Notice the color coding. Green highlights indicate low VXN periods under 20, and pink shows high VXN periods above 20. What's significant here is that our system performed profitably across the entire volatility spectrum. We delivered an 88.4% total return with a Sharpe ratio of 1.95. That's 3.6 times higher than QQQ's Sharpe ratio. You can see we trade both TQQQ for long positions and SQQQ for short positions, which means we're making money whether the market goes up or down. This isn't market timing, it's systematic risk management. Let me break down the performance by direction. Over 12 months, we made 12 TQQQ long trades with a 75% win rate, generating 76.7% in gains. That's 87% of our total returns. But here's what's really interesting. Our 11 SQQQ short trades with a 54.5% win rate contributed 11.7% in gains. That's more than half of QQQ's entire annual return of 18%. And we made it by going short during market weakness. The key moment was the January to March 2025 correction. While QQQ fell 9.4%, we gained 15%. Yes, we experienced our worst single trade drawdown of minus 21% during that period, but the system's ability to pivot to shorts and then catch the recovery turned what could have been a disaster into a profitable quarter. This is the power of true bidirectional trading. You're not just limiting losses, you're actively profiting from market volatility. Think of it like weather forecasting with multiple instruments: barometer, wind gauge, thermometer, humidity sensor. Any single reading can mislead you, but when they all predict the same storm, it's real. Initially, we were manually monitoring 36 different indicators, 9 time frames with 4 oscillators each, scanning for convergence patterns. That worked for discretionary trading, but it's hard to write an algorithm with 36 inputs. We applied a Taguchi-style design of experiments to identify which indicators on which time frames were actually driving the signal. The result, 6 critical measurements on different time frames that capture 80% of the predictive value. When these 6 independent dimensions converge simultaneously, that's our algorithmic trigger, transforming what was manual pattern recognition into a systematic, repeatable strategy. Let's put the numbers side by side. QTrade delivered 88.4% total growth compared to QQQ's 18%. That's 70 percentage points of outperformance. But the real story is risk-adjusted returns. Our Sharpe ratio of 1.95 versus QQQ's 0.54 means we're delivering 3.6 times better risk-adjusted performance. We're not just making more money, we're making it with better risk management. Yes, our maximum drawdown of negative 21% was larger than QQQ's negative 14%, but that single worst trade happened during a period when we still made money overall. And with a 65.2% win rate over 23 trades, we're consistently profitable across different market conditions. This is the kind of performance that can meaningfully enhance a portfolio's returns without requiring massive structural changes. Here's the practical application for institutional portfolios. Imagine you have a $100 million tech-focused mutual fund that's 100% in QQQ. Your annual return would be 18%. Now take 10% of that portfolio, just $10 million, and allocate it to QTrade. Keep the other 90% in QQQ. Your blended return jumps to 25%. That's a 39% improvement in total returns with minimal disruption to your core investment thesis. The math is simple. 90% times 18% gives you 16.2%, plus 10% times 88.4% gives you 8.8%. Total, 25%. This is why we position QTrade as a tactical enhancement, not a replacement. You maintain 90% of your existing exposure while dramatically improving your risk-adjusted returns. It's the kind of asymmetric opportunity that doesn't come along often. Now let me tell you the story behind these numbers, because institutional investors need to know not just that it works, but why it works and who built it. I'm a chartered investment manager with 13 US and 91 international patents. I started developing this system in 2019, tested it on my personal account, and consistently achieved 65% annual returns. Word got out, and friends started asking if they could get the same signals. In 2021, I teamed up with Brad Nightingale to launch Greg's Easy Trade, a subscription-based signal service that attracted paying subscribers. From 2021 to 2022, during a period of high volatility with the VXN averaging around 30, the system delivered 138% annual growth. Even more impressive, during the S&P 500's brutal 20.5% drop from January to July 2022, Greg's Easy Trade delivered 59.24%. The system was proving it could thrive in bear markets. Based on this success, we launched a $400,000 test fund in January 2024 with a few former subscribers. That fund failed, and I want to explain why, because it directly led to the robust system we have today. Volatility collapsed. The VXN dropped to around 19, and our day trading system, which was optimized for high volatility, stopped working. We made only 5.44% in year one and lost 4.59% before investors redeemed their capital in early 2025. That failure was painful, but it was also essential. It forced us to completely rethink our approach. We went back to the drawing board and made a fundamental change. We converted from a day trading system to an all-weather swing trading system designed to work in both high and low volatility environments. The original system used 4 oscillators across 6 time frames. We rebuilt it from scratch, tested 37 different algorithmic variations, and optimized for a custom 41-minute time frame. Then, and this is crucial, we spent 13 months manually validating every signal the system generated before deploying any capital. The result? The 88.4% first-year gain you saw earlier, with a Sharpe ratio of 1.95, working across all volatility environments. We learned from failure and built something better. And that's actually one of our biggest competitive advantages. We're willing to admit when something doesn't work, fix it, and prove the new version works before taking investor capital. So what does this mean for you? The QTrade hedge fund isn't a fair weather strategy that only works in certain market conditions. It's an adaptive long-short trading system specifically built to reduce drawdown risk without sacrificing growth. It's been tested by failure. We know what breaks and why. It's been refined through rigorous iteration, 37 algorithmic variations and 13 months of validation. And it's been validated by results, 88.4% live trading returns over 12 months. For institutional investors, This represents a tactical allocation that can enhance portfolio returns, provide downside protection during corrections, and offer uncorrelated return streams that can smooth out volatility. And because we can profit from both up and down markets, we're not forcing you to make directional bets on the market. Before we move to infrastructure, let me explain our methodology. All performance data you see here is live trading from October 2024 through September 2025. The backtesting looked great, but we refused to deploy real capital until we had 12 months of paper trading, manually logging every algorithmic signal into a spreadsheet to verify the system in real-time market conditions. Our Sharpe ratio calculation uses a 5% risk-free rate, which is standard for institutional analysis. QQQ benchmark data comes directly from Invesco QQQ Trust. TQQQ and SQQQ are leveraged products, 3 times daily moves, which means they carry elevated risk profiles. These are sophisticated instruments that require active management, which is exactly what our system provides. And of course, past performance does not guarantee future results. We're showing you what the system has done, not making promises about what it will do. But the 12-month track record speaks for itself. Now let's talk about infrastructure, because as a small private fund, we know credibility is built on institutional-grade partnerships. All client assets are held at Pershing, LLC, a leading global financial services provider with over $2 trillion in assets under custody. Pershing is a subsidiary of Bank of New York Mellon, one of the oldest and most trusted names in finance. This is crucial. Your capital never touches our hands. Everything remains in segregated accounts at Pershing with institutional-grade security protocols. We execute trades, but we never have possession of client funds. This addresses the primary concern most investors have about smaller funds: counterparty risk. Beyond custody at Pershing, we've established institutional-grade infrastructure. MS Howells and Company provides our back-office operations, accounting and tax advisory, specializing in hedge fund administration. Spicer Jeffries LLP serves as our independent auditor, providing third-party validation of all performance results. Eulish and Associates handles securities and regulatory compliance. The Securities Law Group serves as legal counsel for fund formation and securities law. We're not trying to handle this ourselves. We're working with specialists who do this every day. Why does all this matter? 4 reasons. First, your capital never touches our hands. It's always at Pershing under institutional protection. Second, segregated accounts with institutional-grade security protocols mean your assets are separately identified and protected. Third, independent third-party oversight through audit and legal partners means we're not grading our own homework. Everything is verified externally. And fourth, we have full regulatory compliance infrastructure in place. We're not winging this. We're operating within the same framework as much larger funds. For institutional allocators, this infrastructure gives you the comfort to allocate to a smaller fund with a compelling strategy because the operational risk is managed appropriately. Thank you for your time today. If you'd like to learn more about QTrade Capital, explore a potential allocation, or dive deeper into our methodology, we'd welcome that conversation. You can reach Brad Nightingale at brad@qtradefund.com or me at greg@qtradefund.com. We're happy to provide additional performance documentation, walk through our due diligence materials, or answer any questions you might have about how this could fit within your portfolio strategy. Again, thank you, and we look forward to speaking with you.